And now for our listener questions. If you want your questions answered during the show, go to our website, retireewo.com, and click on Ask a Question.
Our first question, Scott, comes from Craig. Craig asks, over the last couple of years, there has been a movement about de-dollarization in international finance. Will it impact investments, and should it be a concern in my financial decisions?
Craig, thanks so much for the question. It is a topic that's become much more in the news and much more relevant. What we've seen as countries have made it vocal that they'd like to move more and more away from the dollar, what we've seen is that actually hasn't been the case. Dollars utilization in international finance is as high as it's ever been. Where we have seen a decline is in the euro's utilization. So it's really been a de-euro situation, not a de-dollarization. So de-euro is what we've seen. Now, what I would say is international affairs have to impact your overall plan when you're considering investments, and where the dollar is relative to other currencies may make international investing more or less favorable. I think the emerging markets relative to US markets is as low as it's been in a long, long time. It's worth considering. But I think my biggest concern about US versus international has to do with, is there an institutional shift where international companies just aren't going to be the leaders that they may have been in the past? And has the emergence of, say, the big seven companies of the S&P, are they in a position where they'll have a more dominant role in the decade ahead? And you might not see this cycle from US to international that we've seen in the past. Bottom line, de-dollarization, not super concerned about it in the short term, as we haven't seen a real shift, but definitely should still be part of the conversation.
Sharon from Orange asks, I am considering adding new money into the market, but I'm concerned that with the run up last year, this may not be the time to invest into the S&P 500 index. Should I invest in a couple of stocks instead?
Sharon, thanks for the question. I think what we talked about today is that when the market has as strong of a year as it did this past year, it bodes well for the year ahead. So even though the market's already had a strong year, going back to 1950, when the market's been up 20% or more in a year, that following year, 80% of the time, it's been a positive year for the market. Now, it hasn't been a year that's historically outperformed the year prior, but it has been positive 80% of the time. So I think that bodes well. There's a lot of reasons to be positive about the market going into an election year, positive after the market takes a year or more to reach all-time highs. There are a lot of positive reasons why you still could be an index investor. The question is, what index do you want to be in? And are there better opportunities? Maybe you want to consider buffered ETFs. Maybe you want to consider small caps. All different things you should think about. Question about individual stocks. There's always individual stocks that can be attractive. You just have to be careful as a novice investor to not be too over allocated to one position, and make sure you're informed about the fundamentals of that company and that business. If you don't have the time to allocate to the homework, to keeping up with these companies, then you're probably better off either hiring a professional to help you or using broader market indexes to get exposure to the market upside. But in short, Sharon, I wouldn't be concerned about, just because the market was up last year, that there's not growth ahead for 2024. I do think there's potential upside in the broader market in 2024. Our next question, Stephen, for you, comes from Jenny in Mission Viejo. She writes, I'm a kindergarten teacher getting ready to retire, but I may want to stay busy in retirement. Am I allowed to work without affecting my pension?
Great question, Jenny. So you're a kindergarten teacher, therefore you're covered under CalSTRS. Pretty common question we get. There's going to be two main parts to this question. So first part, you are allowed to work in retirement as long as it's in a non-covered role. So what does that mean? Essentially, you're just not working within a school system. So let's say you're working at Angel Stadium, Disneyland, all the common retirement jobs. As long as it's not involved in the school system, you're completely fine. The other side of the coin then becomes if you work in CalSTRS covered positions. The most common one we see is substitute teaching. There are going to be some limitations for that you need to be aware of. The first one, you have to wait at least half a year, so 180 days after you retire before you start working. You're going to be subject to an earnings limit. For 2023-2024 school year, it's about 50,000, and this amount changes every school year. But note, I said school year and not calendar year, and it will update every school year. Any amount over the earnings limit will be directly deducted from your CalSTR pension. So don't get blindsided if one day your pension is lower than the previous months. And finally, just as a good tip, make sure you're keeping track. CalSTRs should keep track of it as well, but they have been known to make mistakes every now and then, have a little bit of a lackadaisical notice that you're approaching that earnings limit. So just keep track yourself. But overall, you're going to be fine. Our next question comes from James, and this one's for you, Scott. James says, I'm deathly afraid of the upcoming presidential election and people not accepting whomever is elected. Why should I just not pull all of my money out?
James, thanks for the question. Over the past 100 years, there's always been a reason to not be investing in the market, whether it's a war, COVID, presidential election cycles, congressional election cycles. There's always a reason to not be an investor. And the beginning of last year is a great example. There was a lot of concerns, a lot of questions. And if you were in CDs or in money market, you were better off invested in the market than in those conservative instruments. You left money on the table. And so I think that's one of the concerns in a higher interest rate environment and in an inflationary environment, as your money needs to keep up and you need to get the growth that you're projecting for your long-term financial security. So I think how you invest, it needs to be part of an overall plan and overall strategy. There are environments where it makes sense to reduce risk, to add more money on the sidelines, to add more dry powder for when there are opportunities, but it's got to be part of a comprehensive strategy. It can't be emotional, it can't be a gut feeling, it can't be, oh, I just am worried about what's going to happen in the market and the economy. The facts and the data show that election years are typically great years for the market. There's a lot of technical reasons why investing right now in the broader market makes a lot of sense. And so you have to take that into account when you're thinking about your overall long-term investment strategy. Just pulling your money out and putting on the sidelines, if it's part of a plan, if it's part of a strategy, could make sense if you're de-risking. But you need to have a bigger picture view, and you have to make sure that you're not making those decisions just based on emotion and based on feelings. It should be based on some technical, tactical, and part of your bigger picture and bigger plan. So as far as the election and people not accepting it, without a doubt, that's going to happen. And I think it's something you have to continue to monitor day to day. There can be bigger risks that we haven't foreseen to the market and to the economy. I think the bigger thing to keep an eye on is inflation over this next year. If inflation comes back, I think the market gets hit. Keep an eye on inflation, keep an eye on what the Fed is doing. Presidential election cycles do matter, but often they can be positive going into that presidential election year. Next question comes from Lori from San Diego. How do I know if my finances are on track? I feel like my current plan is just focused on investments and I have no idea where I am. Stephen, you want to take a crack at it?
Yeah, Lori, this is a great question. And Scott, please add on when I'm finished. This is a common question we get. Here at our firm, we take a very comprehensive approach to our finances. And one of the simplest things that we work with so many clients that came from other advisors is we find that nowhere did they ever write down what their goals are. So a practice that we do with our clients is we want to write down and put on pen to paper what our clients' goals are, whether that be retiring at a certain age. I want to pay off my mortgage. I want to relocate to a different state. I want to have X dollars a month of net income. Whatever those are things that we're going to work through and come at it at a broad financial planning perspective. So many advisors, unfortunately, like what it sounds like Lori may be having with her advisor, is just solely focused on the investments. And the investments are very important, don't get me wrong. A financial plan is like a body and investments are like blood. The body can't live without the blood and vice versa. But it's just a piece of what you need to have overall. So I think making sure that you have clear cut goals and making sure that you have a plan that's going to meet those goals and be able to, obviously, we can't always see perfectly into the future, but having an idea of where you'll be X years down the road, and is your financial plan on track to meet those goals? Scott, do you have anything to add on that?
Sure. Lori, I think that it's a big misconception that a financial plan is only good investments. It's not. It's a lot more than that. And we've got a philosophy here to plan first and invest second. And until you have a plan and a strategy, you shouldn't be doing any investing. You shouldn't be looking at how you're investing unless it's part of your bigger picture. And some of the biggest areas you need to be thinking about with a plan is just what you mentioned, Lori, is what are you on track for your goals? Is your income on track for where it needs to be when you are done working? Where are you going to pull that income from and when? What's the tax status going to be? How do you be as tax efficient as possible? How reliable are your investments? How much are you going to have to rely on those investments to provide for you for income in retirement? What's the tax classification on those investments? And where are you allocating those specific assets based on tax classification? All different things that are integrated and work together and building a comprehensive plan. Investments are a critical piece. As Stephen mentioned, they're a very, very important piece, but they've got to be part of the bigger picture. And whoever you work with, or if you build a plan out yourself, your investments need to be part of your overall strategy and overall plan. If that's something you want to talk about more one-on-one, happy to do it with you. Go to our website, and happy to set up a one-on-one session with myself and with Stephen, and we can talk about how we could build out a plan for you.